My name is Adrian Vincent, and I'm a senior advisor to the Global Seaweed Coalition. And I have the pleasure to kick off this webinar on financing regenerative seaweed and bivalve aquaculture. Thank you all for joining for joining this session today. The main focus of today will be to be sharing some insights about a brand new report that has been developed by Systemiq together with Planet Ocean Capital and the Global Seaweed Coalition, benefiting from the generous support of Builders Vision, to deep dive on the financing need and opportunity for regenerative seaweed and bivalve aquaculture with a focus on Europe. So the goal of today is to share with you the key insights from this paper, and then we will open up the floor for a Q&A with the different players that have been involved in this work, including myself. Without further ado, to kick us off, I'm delighted to welcome on stage Melanie Kweff, a scientific officer at the Global Seaweed Coalition, who is going to share some opening remarks and set the scene for us. Melanie, over to you.
Thank you, Adrien, for the introduction, and good morning, good afternoon, everyone, and thank you for joining our webinar today. So before we go into the substance of the event, I wanted to introduce a little bit more the Global Seaweed Coalition. We are a global partnership established to support the safe and sustainable development of the seaweed sector as it scales up. We do it grounded in science, thanks to a partnership between the French National Research Center and the United Nations Global Compact. We receive initial funding from the Lloyd's Register Foundation, and we've been recently supported by Builders Vision. So we achieve our action through 4 key pillars. On funding, we financed more than 32 projects globally in 27 different countries, channeling more than 1.5 million globally to seaweed-related topics. On science and technology, we share scientific knowledge through informative webinars like this one, which are available through our YouTube channel, and this one will also be recorded there. And we also organize working groups, workshops that work together on project consortia on topics such as biodiversity, seaweed genetic, etc. And last, on policy and advocacy, which I both regroup, we spread the narrative seaweed in global and national forum, where we try to raise awareness and also to support policy change. We recently launched the United Nations Global Seaweed Initiative together with governments and UN agencies that bring together the expertise to bring the mission of the coalition at the next level. So you will have understand, mobilizing funding is at the heart of the Global Seaweed Coalition. We operate with a very lean secretariat, channeling a maximum of funding towards startups, SMEs, seaweed producer, and value chain actor. So now I want to thank our partners. I want to thank Builders Visions and the European Investment Bank that has proven how investors and philanthropists can work together with the Global Seaweed Coalition, bringing their financing expertise to answer the sector's needs. I also want to thank Systemiq and Planet Ocean Capital for leading the analytical work behind this study, bringing recommendation insights on how to size the financing need of the European bivalve and seaweed sector, but also to support this blended finance mechanism. And last, while this study is at EU level, I would like to think that we can adapt and replicate this model to different parts of the globe, Southeast Asia, Latin America, North America. So let's think global and try to replicate this blended finance mechanism worldwide to support a global development of the seaweed sector. And with that, I wish you a very pleasant webinar and good learnings today.
Thank you very much, Melanie. And so now that you have teased us on why the Global Seaweed Coalition and how the Global Seaweed Coalition is partnering with the financing world to unlock additional funding into the sector, it's time now to look at to look at the key insights from this white paper that is now publicly available and you can find online. And so it's now my pleasure to introduce Jennifer Ring, Senior Manager in Sustainable Finance at Systemiq, who has been instrumental in leading the analytical work of this paper and who is going to walk us through the key findings and insights of this fresh new report. Jennifer, over to you.
Thank you so much, Adrian, and thank you, Melanie, as well, for those words. So to start with the ambition for this work, this exercise stemmed from our conviction that more seaweed and more bivalves are good for the ocean, they're good for the planet, and they're good for communities. And that backing this extraordinary impact potential is also very robust market fundamentals and an unrealized financing need. So our objective was very concretely to lay the groundwork for designing new financing vehicles that can mobilize capital to these extraordinary sectors. And per Melanie's comment, we also share the conviction that this is a global opportunity, but we also saw the benefits of taking a tighter regional focus in this work to surface insights that are truly concrete and actionable. And in the case of this work, we dove deep, as you will hear, on Europe. Important to note that this exercise, this analysis builds on existing work, in particular the excellent work from earlier this year by the Global Seaweed Coalition and the European Investment Bank. So what do we cover in this report? Well, we start with market trends, initially taking a global view. We then double click on Europe, diving deeper on pipeline and looking at the financing need and the gap that we see there today. And then finally, we have consolidated best practice for blended vehicles to inform the design of future instruments that can realize this opportunity. So to briefly set the scene, a recap of why seaweed and bivalve aquaculture matter. Tackling the climate emergency and nature loss will require us to transform our global economy, transform the blue economy and our food systems away from traditional extractive and polluting models to regenerative, nature and climate positive alternatives. And done well, sustainable seaweed and bivalve aquaculture can actually be poster children for this new regenerative economy. They allow us to sustainably scale food from the sea. They can create sustainable livelihoods, particularly in low-income communities or communities under pressure from fishing, declining fishing yields. And of course, they generate a host of ecological and climate benefits. They are low input, low carbon, bioremediating, and habitat creating. With all these elements in common, there are actually also important differences, however, in the market structure and maturity of the seaweed and bivalve sectors. But despite these differences, we see that they are compelling investable propositions in both cases. Starting with bivalves, globally, this is a large and established market, estimates of upwards of $20 billion a year in market value. Production is heavily concentrated in China, which has about 85% of industry share, but Europe, North America, and Chile are also notable producing markets. Globally, we see that demand for bivalves has remained relatively steady, and that actually with that, bivalve prices are increasing across virtually all major markets due to a combination of inflation coupled with high demand. So if we double click on Europe, we can see that in the European context, this is a non-trivial sector. It's a 1.3 billion euro market. Production is in the region of 500,000 tons of bivalves annually, and that's about half of European aquaculture by volume. The sector is distributed across mussels, clams, and oysters. And interestingly, there's something of an inverse relationship between volume and value. So mussels account for about 75% of European production by volume, but just over a third of value. And clams, by contrast, are about 5% of volumes, but driving 25% of market value. And in terms of how that market is evolving, we're seeing modest growth of about 3% a year, but notably this is actually driven by an increase in prices rather than an increase in volumes. In terms of the pipeline and the structure of the market, the businesses that we see operating in the European context are heavily concentrated in the farming stage of the value chain, although we are seeing some interesting growth downstream in the processing stage, particularly in the mussels subsector, where we're seeing innovation around waste valorization and byproducts. Crucially, this is a highly fragmented industry. So we see about 7,000 companies, give or take, operating in the European bivalve sector, and 95% of these are micro enterprises. So 10 employees or fewer, an average turnover in the region of 200,000 euros a year. Within this, important to note, there are some much kind of larger organizations. One example, Oceano Fresco, a Portuguese clam hatchery and cultivation company, and we're seeing investment flowing to the sector as well. Oceano Fresco, again, a good example, recently having raised 27 million euros across its Series B and crowd lending. And just in terms of the geographic distribution of this sector, Spain and France are the predominant producing markets, with about 70% combined of concentration of the market. Of pipeline, sorry, let me be clear. Great. And then if we move ahead, pivoting to the seaweed market, this is a sector that is rapidly evolving. Traditionally, when we take a global perspective, this has been highly concentrated, in particular in Asia, with about 97% of total production globally in Asia, and half of that alone in China. And end-use applications for seaweed have also been historically highly geared towards food and food additives. But the sector is changing and growing at pace, particularly in emerging producing regions like Europe, Latin America, and Africa. And we're seeing very strong innovation and growth in alternative application markets, be it biostimulants, biopackaging, cosmetics, pharmaceuticals, the list goes on. And in terms of the potential market for seaweed, Standard Chartered has actually estimated that in a high growth, ambitious scenario, the global seaweed market could be worth upwards of $300 billion in 2050. Double clicking now on Europe, the region is home to a dynamic and growing pipeline. There's about 480 companies, we estimate, that are operating in the region, and that's a figure that's growing at about 15% a year. Estimates from Seaweed for Europe put potential European demand for seaweed in the range of 3 to 9 billion euros in 2030. And unlike the very concentrated end-use applications that we've seen historically, we actually could see animal feed, biostimulants, and biopackaging being strong contenders for share alongside food and food additives in the European context. Total disclosed investment since 2020 to the sector is in the region of 500 million euros, and that's a combination of grant and more commercial capital. And a couple of notable examples of businesses that have attracted finance include Ocean Rainforest, which is an offshore farming pioneer from the Faroe Islands, which raised a little over 10 million euros. Origin by Ocean raised a similar amount there, a Finnish bio-based ingredients for cosmetics and agriculture company. And finally, Alginor, which is a Norwegian vertically integrated biorefinery, which has actually raised 97 million euros. All this is good news, but it would be remiss not to mention the headwinds. So there are challenges that these sectors face. Particularly when we look at the seaweed sector, we see international competition from China and Asia at large as a challenge. For both sectors, there can be regulatory hurdles around administrative burdens, in particular for securing permits or licenses. There can be delays and uncertainty. And increasingly, we are seeing climate impacts as a challenge to the sectors. Warming oceans and acidification are impacting yields. We've seen, for instance, some mussel declines in Italy, and harmful algal blooms and invasive species from pollution have caused closures. Examples include France in 2023. That said, these are also counterbalanced by robust tailwinds, continuing and growing consumer demand for healthy, sustainable, and traceable products, accelerating innovation, particularly as described in some of those in the seaweed value chain, There's also growing sophistication of the sector. So we've seen the development of coalitions and producer associations that are helping address some of the fragmentation and also supporting more concerted and effective advocacy. And there is very strong and growing political support for these sectors. Regional initiatives point to this, things like the European Blue Growth Strategy or the EU for Algae Initiative as well. So all that to say, we have two compelling regenerative sectors, one that is larger and more mature and the other that is smaller but dynamic and rapidly growing. But of course, the prospects for both sectors rely on access to finance. We believe that it's all well and good to talk about the need for finance, but it's also not sufficient. We need to be clear and nuance our understanding of the specific needs of these sectors to understand what types of capital, what types of financing instruments can really be fit for purpose to help them sustainably develop and continue to grow. And our ingoing hypothesis that this work sought to test was on the role for debt financing. And some of the rationale for this is that particularly when we look at the farming and processing stages of the value chain across both seaweed and bivalves, we see that there are a large number of revenue generating businesses, but not businesses that are necessarily targeting significant future growth. And another way of putting this is that there are a high number of kind of SME type profiles in this sector rather than the startups that we would traditionally hear about in the kind of VC space. But nevertheless, these businesses have debt financing needs which need to be met. And we see kind of three core buckets into which those financing needs sit. If we can actually stay with the previous slide, thank you. The first is around managing the mismatch between revenues and costs. So tackling seasonality, enabling businesses to manage their working capital, to bridge cash flow gaps, in particular between harvests, or to allow businesses to respond to adverse events like weather shocks or regulatory shifts. We also see a second bucket of need around financing infrastructure for scale up and resilience. So this could be debt that allows farmers to invest in capex intensive expansion or improvements, be it across hatchery, farming or processing. For bivalve farmers in particular, there's an opportunity for and a need for financing to support the incorporation in some cases of seaweed farming to move towards more integrated multi-trophic aquaculture models. And then the last bucket is really around supporting industry consolidation, be it for companies to integrate vertically or horizontally, or to enable generational buyout or acquisition. If we can move to the next slide then. Another way to think about these debt financing needs is in terms of debt financing archetypes. So indicative debt needs that have broadly similar characteristics in terms of the use of proceeds and ticket sizes. And building on the report alluded to earlier from the Global Seaweed Coalition and EIB, we identify 8 archetypes across seaweed and bivalves, and these range from revolving loans to debt for farming infrastructure or M&A. And as you can see on the next slide, for each of these archetypes, we drew on that prior work to quantify the average ticket size for each of these archetypes in the European context. And we estimated the share of the European pipeline which might encounter these debt financing needs over the next 5 years. And our conclusion is that in the years to the end of the decade, there is actually a 1.7 billion euro debt financing need in Europe alone. 85% of this is accounted for by bivalves, and for bivalves, mechanization and investment in farming infrastructure and resilience were the kind of largest drivers by value in terms of the financing need. For seaweed, which is a smaller share of the total, but material nonetheless, a small number of highly capex intensive biorefinery developments, as well as M&A and revolving loans were the key debt financing need drivers that we saw there. An important caveat, of course, is that we're not suggesting that this 1.7 billion euros is necessarily investable, but it does point to a real need. And if even a portion of this is bankable, it's also a significant opportunity for capital providers. The challenge, however, is that accessing this debt financing is difficult for seaweed and bivalve businesses today when they sort of go through traditional debt lending channels. A couple of reasons for this. One, we're often looking, as mentioned, we have a large number of micro enterprises. We're often looking at small ticket sizes or micro SMEs, which can deter commercial lenders. Collateral can be an issue. There's often highly specialized equipment and in-water assets that may not hold their resale value well. And in some cases, we just have lender unfamiliarity with the sector, compounded by a lack of sector data and benchmarks. And what we're seeing actually is interesting is that some businesses are also looking to alternative ways to raise debt, for instance, through crowdfunding. So Algo Lesco in France is one example there. Important to note as well, of course, we have banks and lenders, but we also have ocean funds. But our analysis shows that of 34 blue funds with aquaculture as part of their investment thesis, 32, so essentially 95%, are actually predominantly providing equity. So this isn't as things stand, these ocean funds are not necessarily able to plug the debt financing gap specifically. So to unlock the 1.7 billion euro opportunity and enable these sectors to develop, to strengthen their resilience and to grow, we need to tackle this financing need. And if we can move to the next slides, we see here a role for, in particular, new debt vehicles, particularly vehicles that are blended or de-risked through, for instance, guarantees or first loss or technical assistance or some combination thereof. The right structure and the right set of catalytic instruments will, of course, depend on the vehicle specifics, which specific business models, which geographies, etc. But there is some best practice on blended finance and learnings that can and should be leveraged. And we believe that really making sure that we are leveraging this best practice is important because many blended vehicles to date have been highly bespoke. The lead time to develop them has been very protracted. The transaction costs have been too high, and in some cases, they have been too complex to be truly palatable for commercial investors. So in order to accelerate and support the development, we hope, of new blended instruments, vehicles for seaweed and bivalves, we have consolidated best practice and case studies. You can see on this slide some of the examples of funds we look to, be they below water or operating on land, and some of the best practice thought leadership that we also leveraged. And on the next slide, you can see a very high-level summary of the recommendations we reached across the full fund design process, from strategy to implementation to ecosystem engagement and fundraising, to highlight just at a high level some of the initial recommendations. First and foremost, of course, is to blend smartly, leverage, of course, concessional layers to de-risk and reduce the cost of capital. But at the same time, it's crucial to minimize complexity. As far as possible, we believe funds should be defaulting to 2 or 3 tier structures with a transparent waterfall. And of course, right-sizing that catalytic layer to ensure it is only as concessional as it needs to be and doesn't distort the market is paramount. Sustainable Ocean Fund is an example of a blended blue fund, of course, that has been de-risked with a guarantee. So there are examples abounding in the blue space here as well. One important additional piece to note on the structure recommendations is to co-develop mandates for the catalytic and investment windows in tandem. There can be a risk that sometimes activities and incentives are not well aligned between the more catalytic and the more commercial parts of funds, particularly where more complex structures exist. Second key recommendations to highlight are on the importance of aligning instruments to cash flows. Debt financing, of course, is really an umbrella term, and we need to understand concretely how to fit different instruments to borrower economics. And that may call for employing flexible models, things like revenue-based lending, the use of grace periods or seasonal loans. Energy entrepreneurs Growth Fund is one example of a fund that has employed flexible debt structures that are well aligned with SME cash flows. Third piece to highlight is the importance of building pipeline credibly through technical assistance and partnerships. There's always a risk of developing funds that then struggle to actually deploy capital. So finding ways to embed technical assistance to support origination, for instance, using design stage grants and feasibility support, or using technical assistance to standardize terms and structures. Can help make sure that quasi-bankable projects or marginally bankable projects actually become investable. Eco Business Fund is an interesting example of a fund that has paired credit lines with technical assistance to de-risk both banks and borrowers. And then last but not least, of course, we must be embedding transparency and ensuring impact is measurable and communicated via shared KPIs and adherence to ESG standards. And also creating visibility on returns is important because this is how we can create track record and crowd in other finance providers to these sectors that are so important for the planet and the communities that they receive the financing that they need. There is much, much more in the report, but we will pause there. Hopefully this gives others and everyone on this call a bit of a flavor of the grounds for optimism and deepens the evidence base for how to concretely unlock this opportunity. Now, very happy to open the floor to questions, and I have with me Adrian, who we heard from earlier, and hopefully Michael White as well, who's a partner at Planet Ocean Capital, who were part of one of the other partners for this work. So I think we will either go to questions in the chat. I think we have a few here, and otherwise we will allow people to raise their hands and we'll go to people there as well. But maybe we start with the questions in the chat in the first instance. Will we be sharing the slides after the presentation? The good news is that our white paper basically is these slides with some extra slides added in. So we can try and share the link for the report. Maybe someone can put it in the chat now actually. And anyone who is interested to revisit any of this and indeed peruse it in much more detail, there's many slides behind this, can find all that there. Question: what is the main motivation for public or philanthropic donors to offer concessional capital in this sector compared to others? Did we see any data from an employment or social development in low income area perspective that could also be attractive? Michael, if you're with us, do you want to take the first question? And then we can move on from there.
Very much. I think in terms of looking at emerging markets and low income areas, there are clearly examples of many funds that have been raised to do that around agribusiness, agricultural value chains, energy and food. And so in principle, there are investors certainly available when we're looking at either emerging markets or low income markets. However, when we start to look at more developed markets, would there be investors willing to take that particular position? And we have looked at it quite carefully. There are certainly a number of groups such as IKEA and with their foundation entering into the sector. There are foundations obviously active in the sector. And in fact, many of these bivalve and seaweed companies have been also match funded by local development agencies. So there is a considerable sort of activity already taking place amongst both philanthropic as well as public sector agencies.
Thank you, Michael. The second question, yeah.
Maybe to complement, especially on the first part of the question, I don't know if this is from Callum, Yunus, Thailand. You are asking what is the main motivation for public or philanthropic donors for this concessional capital? At the highest level, you can think about a number of motivations around sovereignty and strengthening food security. You can think about creating jobs in coastal communities that are suffering from a higher unemployment rate, and you can think about boosting economic development. So at the highest level, this is why those two sectors are primary interest. And then being a bit more in the details, if you look at the European Commission and the different branches associated, including the EIB or the EIF, who have been involved in the first part of this work, you also have existing blue economy strategies, especially in the spirit of boosting transition to more sustainable models. And so those kinds of instruments that we are talking here is a way for them to use their public money in the most catalytic way, on top of just providing grants or research grants. They can really expect to generate this kind of multiplier effect and leverage effect by providing concessional capital in those sectors aligned with their strategies.
Brilliant. Thank you both. In terms of maybe just tackling a couple of these other questions, in terms of case studies of what has been funded so far around bivalve. So in the report, we include other examples of businesses that have publicly disclosed financing. Often what we found, in particular for bivalves, is there wasn't a huge amount of public data on this, and a lot of what was visible was relating to grant funding, which obviously is, fills an important gap, but isn't necessarily scalable when we think about the size of the sector at large. The most one of the more at least prominent examples of bivalve businesses attracting commercial capital is the Oceano Fresco example that I mentioned, but to the best of my knowledge, that is actually equity financing rather than debt financing. So this is sort of part of the gap that we identified. Obviously, in many cases, lending by banks wouldn't be public though. So we are dealing necessarily with a kind of sample that is not fully representative. But hopefully that you can also look in the report for kind of more details on that as well. There's a question to elaborate on the regenerative potential of the sector. Adrian, I don't know if you want to take a quick punt at that. I'm sure there's hours that we could spend talking about this, but maybe just the high level.
Yeah, first of all, I think there is a matter of aligning on the definition of what is a regenerative sector and ocean sector. I've seen Raffaella Leguvelo being connected, so that's good news. We referred, and Jennifer referred in the presentation, to this recent paper published by IUCN trying to define what is a sustainable ocean economy and a regenerative ocean economy. So the concepts are now being slightly more defined and more clearly established. What makes seaweed and bivalve sector regenerative is the spirit is that they give more than they take to the environment they evolve in. So if you look at seaweed and bivalves, they are filtering water, they are taking extra nutrients that we often have in coastal waters that are flooded with nutrients runoffs from land. They are helping, for the seaweed, they are helping with reducing the acidity locally and helping to mitigate the effect of climate change. They are also providing habitats, and bivalve being filter feeders, they are also helping cleaning the water. And in this spirit, the idea is that those guys that do not need external inputs, and still they are providing outputs for human applications. So that's what we consider them as regenerative. To know more, I invite you first of all to look at this IUCN report I was referring to, and then of course read the report and the previous one, the one that we published with the Global Seaweed Coalition and the EIB last March, which have many more details on the arguments behind those claims of regeneration.
Brilliant. Michael, maybe this is one for you. There's a question. Debt funds have clear exit pathways. What are some things a fund should keep in mind to have high operational efficiency to meet volumes game and have attractive returns for LPs?
No, I was reading exactly the same. Thanks, Sol. I think debt funds, quite rightly so, they do have clear exit pathways because you're basically repaying of the debt. But I think the practice, of course, with debt funds, and most of the debt funds I've had experience with are, again, sort of in terrestrial situations. And one of the things I think helps a lot here when you're going into what I still consider to be an emerging market, albeit in Europe, is a good technical assistance facility. And I think the TAF does a lot to basically help prepare the lenders on, what are good lending practices in terms of having forecasts and visibility over cash flows and how the terms work. And I think similarly in mind, when you do a debt financing for in emerging markets, it looks very much like an equity financing. You'll basically do a cash flow projections to see how the business is performing and what the use of the capital is, because quite often these are unsecured loans, so you're looking for cash flow to repay them. You may put in place certain terms where there's a interest holiday in the first 1 or 2 years. Certainly, if you're looking at a CapEx project, then you can look more specifically at the repayment against the CapEx schedule. And then I think to have high operational facility, I think you've also got to monitor them to a certain degree, as you do with an equity investment. So you want to make sure that there's no slippage in terms of repayment of interest or any other terms, that you get an operational report from the lender so that you can track their progress. And I think on that basis of all, you're trying to de-risk as you go through the whole process as a good credit manager of the counterparty to the loan. But again, this is well established rules. The difference between ourselves and a bank lender, which would be the other way that you could possibly get money out of the sector, is that there should be industry expertise on the lending team. So the team understands the cyclicality of seaweed production or bivalve production. They're aware of some of the impacting factors such as climate, access to market. So we become a lot more intelligent as lenders and are much more aligned with the companies that are looking for the capital as well.
Brilliant, thank you. Adrian, there's two questions. One on, I guess, the logistics of integrated multi-trophic aquaculture. How does that work at a high level, and what are some of the implications? And then the second is on vertical integration that includes biorefinery models, and what might the implications for financing be there? Maybe you can take those together.
Yeah. So if I take the first one, about bringing together or cultivating together bivalves and seaweed. So I'm sure many of you attending this webinar have heard about IMTA, integrated multi-trophic aquaculture. It's a concept that has been around for I think at least a couple of decades, if not more. The reality is that most of the IMTA project by design, so really starting a farm that grows different species along those different groups, mostly have remained at the pilot stage. Yet we see now a burgeoning of projects which are more starting with established bivalve infrastructure and cultivation, progressively expanding or adding some seaweed cultivation modules to their farms. And so it's more likely that statistically, it's more likely that it's going to develop like this, building on companies who already have an experience at sea, already have access to licenses, to coastal infrastructure to manage their bivalve, and who want to diversify risks, who want to diversify their sources of revenues, and want to grow seaweed next to their farms. In theory, and it's still there are still a lot of scientific work ongoing to really put concrete facts and demonstration behind that. Growing those species together is likely to create synergies. And in theory, if you have enough seaweed around or next to your bivalve, the fact that there is a reduction of acidity is expected to strengthen the shell development and accelerate it. And there could also be some more biological effects in terms of meat density or speed of growth. And there are currently a number of studies ongoing that are trying to demonstrate that. So long story short, we wanted to explore those two industries because we feel like they are very complementary and they are like cousins. Now, are we going to see, or what we expect is that most of the financing need today is for seaweed only or bivalve only, with just a small part of combining the two. Now, the second question that talks about vertical integration, I believe it refers to one of the archetypes that was mentioned in the presentation. So those archetypes were identified in the previous report that was developed with the European Investment Bank and the Global Seaweed Coalition. And here, vertical integration refers to players who want to develop faster by acquiring or merging with either their suppliers or the kind of client on the value chain. And so what we have seen on the market is, for instance, a processor securing its supply by acquiring a farm, or it's a farm securing some processing know-how and capabilities and infrastructure by acquiring what used to be their off-taker. And so those are the kind of operations that we are already seeing a little bit and that we expect to continue to see, and where debt financing feels like a relevant tool to allow those kinds of consolidation operations rather than having to build only on equity, and that comes with a dilution of the ownership and could make the operation more complex.
Great, thank you. There's a couple of questions that are sort of getting at a similar point, which is around where specifically is the funding gap greatest, be that in terms of the investment life cycle or stages of the value chain. I'm happy to kind of take a first go here, and Adrian, Michael, please jump in. But typically, the economics and the fit with existing financing are more challenging upstream in the value chain. So around the kind of production and processing to an extent stages of the value chain, what we typically see is the kind of VC early stage equity piece is much better equipped to take on some of the innovative applications that we're seeing more around the marketing and end use part of the value chain, so further downstream. Adrian, Michael, I don't know if you would want to add anything there.
I think there's a couple of emerging areas where we know that there are gaps. And one of the gaps, as you mentioned, Jennifer, is in further upstream, but it's not just further upstream. The problem is you need to basically have financing going through the whole production cycle. And so a lot of the processors get caught in a rather problematic situation, and that not having enough working capital or balance sheet finds them hard to then go to suppliers of biomass and enter into purchase contracts for the upcoming production cycle. Similarly, it makes them less credible when they go to suppliers saying, we want to supply you with a certain amount and trust us, we can do it. So I think what we're trying to do really is also address this value chain all the way through. I do know certainly of some producers in Norway and Sweden that are now moving more towards processing. And of course, they're now going out to the market trying to buy biomass. And, as you start to ramp up volumes, you're going to start to see increasing stresses amongst this value cycle as we go through it. But that's great. I think that's a good problem to have, because then we've got at least demand side coming through on the processed products that can then sort of filter through then on the biomass production side.
Yeah. There's a question on the high real and perceived default risk and what the potential mitigations here could be. So I think a couple of things. One, when we're talking about the kind of real default risk, obviously if that is at levels above what commercial investors' preferences or tolerances in light of the returns, then that is exactly a kind of a good use case for blended models. So that is why we are exactly why we are thinking about how blended funds could be structured to serve this industry. Some, however, of this is a kind of outsized perception of risk, driven, I think, in large part by the fact that these are not necessarily sectors that lenders are familiar with. I think there can be in some quarters a great embrace of the kind of climate and nature positive investment agenda, but in other areas, a kind of lumping together of solutions, nature-based solutions that are at kind of very different stages of maturity from an investment perspective. So I think finding opportunities to make sure that we are being transparent about data, that investors are publicizing not only impact but as far as possible also the results and the kind of the investable pipeline and the results of those investments is important to sort of debunk and bring a bit of a kind of literacy in some cases to these lenders, but concretely, obviously, the more data that we have, the better that we're able to address these perceptions as well. If anyone else has got to a question further down the list that I haven't, Adrian, Michael, please feel free to
get back on that one, Jennifer. I think that when we talk about blended finance, what we're talking about in reality is some sort of a mechanism around the structuring of the loans. Or the structure of the fund that makes them able to sort of give the protection level through to certain investors that their investments would be protected from a principal position. And that means we'll also look towards guarantees. So not just having a cap structure with a first loss provision. That's one version. Another version, of course, is to have guarantees that make that available. And the Sustainable Ocean Fund that was created about 5 years ago did that with USAID providing a guarantee. Many of the terrestrial funds have guarantees. So again, none of these things are new. And the other thing you talk about, high risk and perceived default risk, I think, again, we have to sometimes look at what's happening in terrestrial as to what should be happening with ocean. Certainly the agricultural sector is well served in terms of loans for capex, working capital, etc. But ocean-based solutions find it harder because they're smaller. And I think we have to address, is that a real risk or is it a perceived risk? But we'll certainly be looking to analyze that as we look forward to making debt available.
Right.
I'm happy to take another question that I found, Jen. It's a question that says that 90% of ocean farms and aquaculture are family-sized or small-scale operations, and the person asks, how did we consider how financing can better serve those businesses? And I find this question extremely relevant because that's really the starting point of this whole journey that started a year ago, where we had this feeling that the space was overwhelmed by, and when I say the space, it's mostly the seaweed space, but to an extent also a bit the bivalve space, overwhelmed by startup/VC approach, which only represent a fraction of the players that account for this industry. Let me explain. Startups, in the traditional sense of things, are really companies that expect to burn cash for many years to then develop their product that is supposed to be really disruptive and bringing something new, and they really want to disrupt the markets, and so they expect high growth, high ambitious development, and so on. And to get there, they need to receive a lot of funding in the form of equity funding, because it's a bet that investors take, and those companies are generally not generating revenues in the first years, so they need the investors to put equity funding. And because people have started to talk about seaweed some years ago, like maybe 10 years ago, especially in Europe, as the new big thing to consider, a lot of those VC investors have come into the space and have started to look at how they could be investing in the new seaweed companies. And there has been progressively a bit of a growing frustration and a reality check that the reality is that apart from a handful of startups per se in those spaces, the vast majority, as raised in the question, are more future SMEs that do not necessarily expect to be doubling or tripling or quadrupling over the years. They are supposed to remain small scale or medium scale, And it's really very different from the startup trajectory where it grows, and then you sell, or then you go public on the markets. So for those companies, we really realized that there was a mismatch between all those very active investors in the VC space and what the sector really needed. And so that's how we decided to really go deeper on this debt financing need, which is supposed to be much more adapted to those smaller structures, to those SME profiles. And so I think the whole point of this report is to say it starts with a recognition that those sectors are overly dominated by small-scale players and SME type of players that do not match with the whole VC financing and equity financing game.
Brilliant. There's a question on the extent to which debt funds would be looking for bankable offtake agreements, and where in that case we think these might come from in terms of sectors or types of player.
Yeah, I read this. Thanks, Christoph. I was thinking it through because I know that I'm working substantially more these days with Norwegian biomass producers, and they're certainly seeing increased demand coming through from other groups that are expanding into processing. Now, how reliable are those on a year-on-year basis? That's always going to be an issue as to how you can look at the business plan of the offtake provider to see what their demand is and modeling that through. And it's like most agricultural businesses, it's going to have to require that sort of analysis and understanding. So if there is somebody who's going to do your offtake, it's either you're doing it internally. So if you're something like ocean rainforest, you're doing your own biostimulants. So you look at your own processing. So you're sort of putting together both supply and processing, or you just have to get a lot closer to the groups that are sort of expanding on the processing side.
Great. There's a couple of questions on what policy shifts might, well, in the context of, for instance, subsidies for European agriculture, but I guess more broadly, are there kind of regulatory or policy shifts that we think would support the sectors and the development of new funds to finance them?
Yeah, so on this one, I can try and comment. First of all, so if you look at the seaweed space, not the bivalve necessarily, but the seaweed space, some of you might be aware that there is at the European level a policy program called the EU Algae Initiative, which is made of 23 actions that the European Commission committed on to help develop sustainably the algae sector in Europe. Among those 23 actions, some of them, I think a couple of them, refer to the need for the Commission and the different vehicles and tools gravitating around the Commission to help develop blended finance vehicles, to help facilitate access to capital and so on. So in theory, the framework is there, and it has already been identified by policymakers that it's part of what they can help doing to unlock the potential of the sector. In reality, so beyond this policy program and announcements, most of the funding today still goes from the European sources, still go to research programs as grants through Horizon Europe, through MFAF funds that are distributed locally. So this is mostly about conventional funding or / public subsidizing, and not yet fully embracing this blended finance mechanism with this whole leverage effect of let's make sure that every euro of public money I invest somewhere gets this kind of catalytic effect and help de-risk to attract another 3 or 4 euros of private funding. So this is not completely embedded yet in public policies. And yet, I think it's good to remind that this whole work started also under the leadership of the European Investment Bank, who approached the Global Seaweed Coalition to think about how this public funding vehicle could be playing a more substantive role in the funding of seaweed and bivalve. So there is this willingness to be more catalytic and to be championing those new blended finance mechanisms.
There's a question about the role of additional cash flow contributions, for instance, from payment for ecosystem services, restoration, etc., and whether there are good examples of business models integrating those revenue streams.
I can give one or two references. One of the companies I work with quite closely is Sea Forester, that does restoration. And they have clients, you can go to their website and find out who the clients are. But they basically pay them on a hectare basis to do using seaweed for restoration. There are other groups who, of course, use seagrass, but seaweed is a unique mechanism suitable for rocky and less stable substrates. And WWF is an investor in that, along with Schmidt Marine. So there are certainly groups that support seaweed as a restoration material, and where you can also earn incomes for your restoration activities.
And we may be
There's a question I'm happy to take as well, Jennifer. It's again by Callum, and I think it's a very good one about the role those kind of debt blended funds could play for newcomers and new SME entrepreneurs entering the sector. And I think you're spot on, because the reality is when you start a seaweed business or you start a bivalve business, very likely the first 2 years or maybe even more years, you won't generate yet the cash flows, positive cash flows, to be able to reimburse the loan and the interest to your loaner. So that there could be a mismatch here. And so that's why I think the kind of debt financing we're talking about here is mostly for established players, which can be still young players, but established players who want to, when it comes to the bivalve space, to increase their resilience in face of a changing climate and modernize themselves and continue to reduce their footprint and prepare for the future. And in the case of seaweed players who want to accelerate their development and their growth, their capacities and so on. So in majority, this is more likely to be for those established existing players, and established could still be not so many years. One could imagine some exceptions, and that's why we identified among the different archetypes this idea of helping with handover of existing farms to new farmers. And this is especially true in the context of bivalve farmers. Today, when a new farmer wants to take over from a bivalve farmer who is retiring, it's quite difficult to access funding and debt funding from a commercial bank. And so that's in this context, a dedicated blended debt fund could be able to maybe serve those kind of profiles who want to renew the generation of bivalve farmer and help them take over from all the older generation. But I'm not completely sure this kind of debt funding mechanism is perfectly fit for purpose to really help newcomers to start from scratch. Here, I believe this is where European level and national, if not regional level grants could apply to help people set up, and maybe with a bit of philanthropy. And the debt could only come a little bit later in the journey of newcomers getting established.
If I could add something to that, Adrian, one of the things that we'd looked at is how do we make capital available to small lenders? And so what we were thinking is to provide a facility which is sort of allocation from a larger facility, backed by the technical assistance facility, that would basically try to sort of automate and make more easier and for smaller loan amounts, as a way of sort of getting out to these smaller SMEs that need funding. And on the other side of that, EIB now has a venture capital debt program, where I know at least one company in in the seaweed sector is potentially looking to participate, but that is for larger volumes. That's in the range of 15 million and up. So there are a couple of programs going that we're thinking of at both ends of the scale that could be useful as well.
Brilliant. We are perfectly at time. With that, I might close the session and just say thank you again to all our speakers, to our partners, to Builders Vision who supported the work, and to all of you for joining. And yeah, have a great rest of your day, everybody, and hopefully see you soon.